What's up, guys? This is Ryan G coming at you with your weekly market update after a brief hiatus. I hope you all had an awesome 4th of July. Let's jump right into it. Dominating the news cycle recently has been inflation fears, so let's take a look at what the broader markets are telling us. The equities market. So equities markets have for sure been the loudest in signaling that a downturn is coming among financial markets. The S&P 500 finished the first half of 2022 down 20% in bear market territory. Since 1950, about 70% of bear markets have coincided with recessions. If we take a look under the hood of the stock market, the sectors that have performed well this year, aside from energy, are defensive parts of the market: utilities, commercial spending, and healthcare. These are traditionally considered recession-proof, as households generally consume these items regardless of economic conditions. So what does it tell us when investors are flocking to these sectors? That they're expecting a recession. The bond market. Bond yields inched lower after moving dramatically higher for much of this year, driven by sharply rising inflation and Fed tightening expectations. The 10-year yield, which drives much of the mortgage market, reached a high of 3.5% in June, but finished the month a half point lower, offering some much-needed relief in mortgage rates. Rates dropped modestly last week, but are still significantly higher year over year, with most programs hovering the mid to high fives depending on your financial situation. This move lower in yields is likely driven by a flight to safety by investors and a flattening yield curve. I won't bore you with explaining the yield curve in depth, but it's the difference between the 2-year and 10-year Treasury yields. This chart shows the rapid rise in yields earlier this year and the flattening of the curve, which currently sits at 0.05%. If it drops below zero, known as an inverted yield curve, it's historically a pretty solid signal of a pending downturn ahead. There tends to be a 6 to 18 month lead time before the recession hits, so investors are going to be watching this very, very closely for an inversion. Next, we have commodities, which are showing early signs of rolling over as global demand softens. Given this year's inflationary pressures, there were limited places for investors to hide in the markets. However, the energy sector and commodities markets broadly held up nicely, with crude oil hitting its highest point in a decade. That said, more recently, we're seeing commodity markets weaken again. We see industrial metals especially starting to roll over, which could be a leading indicator of slower economic activity around the world. In particular, copper, often called Dr. Copper because it can be an indicator of global economic health, has fallen precariously over the past few weeks. Finally, looking at currency markets, the one standout has been the US dollar, which continues to push higher this year. Historically, periods of elevated inflation would negatively impact the dollar, eroding its purchasing power. However, as markets around the globe battle their own inflationary pressures and concerns about slowing growth rise, we continue to see the US dollar act as a safe haven asset for global investors. We would expect the dollar to remain elevated in the near term, especially as the Federal Reserve continues its aggressive tightening policy. So, what does this all mean? It means that 4 major financial markets are flashing signs of an economic downturn ahead. And while the doom and gloom can be a little bit exhausting, it's important to remember that economic downturns are part of the business cycle and have always been followed by a bull market. The average bear market has returned negative 34%, which sucks, but the average bull market has returned 167% and has lasted significantly longer, as shown by this chart. So while bear markets are never comfortable, they do offer you an opportunity to ensure that you're properly diversified. It gives you the chance to rebalance assets if necessary and also look to add quality investments at a more favorable price. These are all things that we'll continue to monitor for you over the coming weeks and months. And in the meantime, try not to panic sell. We'll see you next week.